uh, stop me wherever you think that you need more clarification. Okay. So it is not a very complicated thing, but you need to understand it. Once the basic is done, you will find that, the coming the course plan what we have, it will be very easier for you, and you will find it interesting also, because analyzing a company, it is needed for the large big businesses, as well as when you are going to set up a startup. Okay, startup firm, you are forming a startup. So in both the context, this understanding the basic accounting and finance is very, very important. Okay, so you just stop me, because otherwise, later on you will find it difficult if you don't understand it right now. Okay, so we were here only, and I was discussing not about, as I told, that time to time I will discuss that how we can deviate from the basic format of recording and all, and how we can tweak the numbers, how we can I mean so when you, as a learned person, when you are going to interpret or analyze a statement as an investor, or as a founder, when you're going to manage your company, investor, when you are outsider, you are going to analyze a company, you need to understand that what are the story behind those numbers. That is very important, right? So in any annual report, you will find that apart from the financial statements, just below that you will find there are notes to accounts. That is also a mandatory section in any annual report. And that notes to account, it actually explains that what those numbers in the financial statements that talk about. So the details of that you will find in the notes to accounts. There you will find that, say for example, the shareholding, the number of shares, the share capital which is mentioned over there, or the asset which is mentioned over there. So what is the depreciation policy they have, what is the company's policy, or what is the standard they are following to record that particular item. If it is your intellectual capital, how they have recorded it. If it is, say, your amortization, if it is some kind of revenue recognition, so how they have, what is the guidance they have followed to record those transactions, that detail has been, you will find it is provided in the notes to accounts. Okay, but as I told that even there are few places where you can apply, the management can apply their own discretion, and they can change the numbers. So so that is called the management of profit, or the management of earnings management. And the more you try to manage your earnings, that means there is a concept of quality of earnings or quality of profit. So the stricter the regulations, the higher the quality of earnings. And you will find that why the investors all over the world, investors now, there is it is an open economy, right? I mean, the borders are open. Investors can, in India also, foreign investors can invest in our country, the firms of our country. So now, how to attract the foreign investors? It not only depend on how your company performs or how the industry performs, it also depends on how overall the country's regulations are. What is the level of efficiency of the capital market? What do we mean by efficiency of capital market? Capital market are of three types. Okay, weak form of efficiency, moderate or semi-efficient, and it is strongly efficient. Okay, so capital market, what do we mean by efficient capital market? The more and more there is, the less and less the information asymmetry, the more and more transparency is there. That means the cap market is more efficient. What do we mean by the capital market? First of all, anyone can you tell us that what I mean by capital market when I'm using the term stock market or capital market, what it is? Hello. Are you there? Hello.
Ma'am, the markets where
Okay.
the
So
capital is generated by exchanges like shares, bonds, etc.
yes, yes. So when I am if I talk about equity market, so what does it mean?
Ma'am, where investments are done in getting like in taking equity.
Hmm? So
That
how I mean how the capital market I mean functions? Any idea? We always talk about capital market, stock market, right? So how it functions? What are the index? Any idea? Anyone can want to tell something about that? Okay, so I mean for the time being, just think about it. The listed companies, the companies whose shares are listed, means I mean there are stock exchanges. Say for example, in India, name a few stock exchanges. Anyone? Do you know the name of stock
NSE,
exchanges?
Bombay Stock
NSE
Exchange,
and BSE.
NSE and BSE.
NSE. So the full form of that, the full form of NSE and BSE?
Bombay and
National
National
Stock
Stock Exchange. Bombay Stock
Exchange.
Exchange.
Yes. So you please raise your hand before you answer, huh? Because I mean there are overlapping voices I am finding. So NSE, BSE, National Stock Exchange, Bombay Stock Exchange, there are stock exchange where the listed companies shares are being traded. Okay. So what does it mean? I mean when the company and what is the purpose of having that capital market? So think about a company, you are going to start a business. You need a very less amount of fund because your operations are not in a large scale, right? But as your firm is growing, the amount required, the fund required, requirement of fund is also growing, right? So where from you will get the fund? First, you will approach some, private fund providers. If you're talking about the equity fund, okay? Orpon, you have raised your hand. You want to say something?
Yes, ma'am. Like who controls the stock exchanges? Like who sets the rules and regulations for a stock exchange?
So here in India, it is SEBI, okay? Security Exchange Board of India, which is the regulatory authority of the stock exchange. We need to follow the SEBI guidelines for listing and for other purposes also. I mean, what the disclosure requirements of different compliances, it is the regulations is given by provided by the SEBI. But now the thing is, think about it. So the more and more you require the fund, the more and more, so whom you will approach? So you will approach first the investors. Maybe when I talk about equity, when I talk about debt, it is a different story. We will talk about then the, banks and all. I'm not going to that. I'm only discussing about the equity fund. Okay, equity and debt and difference between equity and debt already we have discussed. Yes, Pranav?
Hello, ma'am, am I audible?
Yes, yes.
Ma'am, I have a doubt that why do we need two stock exchanges? The companies are
This is
there are
because
various.
of the this is because of the efficiency. The if the all the stock exchanges are not, similarly, they are not of the same capacity or similarly they are efficient. So due to the inefficiency of one, another one has come up, and you will find that there are different kind of. There is a competition between NSE and BSE also. Okay, and there are say and also say for example one stock, one particular company's share, if it is listed in many stock exchanges, that means it is more, what I should say that, first of all it can raise more shares, it will be more visible, it can raise more fund, and it adds to its value also. In a sense, for example, there are other stock exchange of outside India also, New York Stock Exchange, Nasdaq, and also if you find that this company, this particular company A is cross listed in many exchanges, So that means it is more credible in a sense. So it can, investors also have more trust on that company, the stock, and it can raise more fund also. It can be more visible. But at the same time, when you are listed in different exchanges and different countries' exchanges, you need to comply many regulations and many guidances, many standards as per the compliance requirement of the different exchanges. Okay. So now the thing is, let me not go into the details of these. Let me just, try to say that why I am raising this issue, this particular issue. Because once you are growing, so you need more fund, and for raising more fund, you need to first go to your private investors and then to public at large. So how will you get the access of public fund? So then the requirement of listing your stock in a particular exchange is, comes into the picture. So when you are going to list your company, when you are reaching a certain stage, then you can list your company, because there are different kinds of requirements for listing. When we will discuss the Companies Act, we will come to know about that. What are the listing requirements and what are the what are the process step by step, how the companies go for listing and why the companies go for listing. But it is mostly because you need to raise more fund, and for that you need to get listed. So for that, what you need is the investors should know about the company, right? And when you are, what is the purpose? If you are listed, then there are many compliances on the disclosures. So the disclosure requirements are far more higher for a listed company than for a private company. So what do we mean by disclosure? The disclosure means the corporate inside the corporation, many things are happening, right? So what are those information the investors want to know? Because based on that only they try to analyze the company, and they try to foresee that where the company is moving toward. Based on that only they will decide to invest. Okay. So this information disclosure is a very, very important thing for the investors. So higher the information asymmetry, the lower is the efficiency of the capital market, and the investors will be reluctant to invest in those stocks if the asymmetry is lower. So because you know that as a founder, you will always try to, it is not always your fault when you are going to project, when you are going to prepare a business plan, it is not your fault that you are showing the numbers on a higher side. But you are over optimistic, or you are very overconfident about your company, and you are showing the numbers, your review, your forecasted revenues, your forecasted profits. It may be higher, whatever you are showing in your plans. But investors are very skeptical, right? Because they do not know, and also they are very experienced investors, not the retail investors, the analysts and the big investors. They are experienced investors. They know that what you are projecting, it may not happen because of many issues. So that's why the more and more information you provide to the investors, it is more easier for them to take a right decision, right? So for that, and also there is always a tendency by the owners or the managers, as I said, to change the numbers, the show the bottom lines, that means the profit and earnings, so that they can attract more investors, they can gain the confidence of the investors. Okay, so that means that's why investors want more information to have to get the confidence over the company. So it is not that, so farm to farm, that information asymmetry may vary. Industry to industry, you may find that the information asymmetry may vary, and the economy to economy also the information asymmetry may vary. So when the more and more you have a stronger capital market, the more you can attract the investors, and you can attract the foreign investors also. Okay. So this earnings management, the more and more the earnings management happen in a country, it is said that the earnings quality of that country is poor. Similarly, if a firm goes for earnings management a higher earnings management, so that means the quality of earnings of that firm is poor. Okay, so this quality of earnings, this thing is very important, and For that, you need to understand that what is earnings and what is earnings, how we can manage the earnings. Okay, so it is, again, I am telling you, it is not a fraud, but you are not giving the true picture. You are doing something else and you are showing something else within your, I mean, without uh, I mean, avoiding the regulatory requirements. You are following the regulations, but still you are doing something. You are modifying your numbers. Okay. So I have just given few examples that how we can show the numbers in a different way. Now let me again discuss the terms. So just remember again the balance sheet format, what I have shown to you, the I mean the um, asset side and the liability side. Now coming to the asset side, I have discussed what is asset, the future economic benefit when it gives, and the current asset. Current asset is the short-term asset which which gets converted into cash within a year. That is what we follow within a year, within 1 year, when it gets converted into cash. That is the current asset. For example, the receivables, the inventory, it has a very short I mean span, the lifespan. Then comes a fixed asset. Fixed asset is remains for longer period of time. That means more than 1 year. It is going to give you the benefit. The examples are the plant and machinery, the land and building, and all these. Okay, the intellectual property. All these are the examples of the long-term investments. Okay. Property, plant and equipment. Now comes here you will find that one term, that is the depreciation. So when we show the fixed asset, say for example this PPE, that you will find this particular term, property, plant and equipment. So this PPE, when we show, we also show the depreciation. So what is depreciation? Anyone, what is depreciation?
Decreasing the value of something over time, or decreasing the value
So
of an asset over
yeah,
time.
so depreciation is it is defined as a wear and tear of the equipment. Okay, so that means the fixed asset, what you have, that the value of that fixed asset does not remain the same. Say for example, if the lifespan of the asset, you have decided that you know that it is of 10 years. Say for example, the personal asset, you have a car. So after 10 years, it will not be of the same value, right? The value will decrease because of the depreciation, because it will not work, as it used to work 10 years back, right? So that is the value of the asset depreciates over a period of time. So what we do is each year, say for example, you have purchased a machinery this year in year 1. So in year 2, year 3, year 4, each year you will apportion a part of it as depreciation, and you will take out it from your balance sheet and you will put it as expense in your income statement. What does that mean? That this value is no more. This value has decreased from that asset and it is expensed in a particular year. So now yesterday one of you asked me that why we, I do not remember what is the item you asked, but you asked me that why we take a particular amount, regarding advertisement, right? The deferred
Yes,
revenue
ma'am.
expenditure.
Yes, ma'am.
So why we take out a part of the total value of that particular asset and we put it in our income statement as expense. So in accounting, there are few principles which are very important that we follow for our reporting purpose. So what are those principles? One I already discussed yesterday, which is the separate entity concept, that you and your business are two different entities. That's why when the owner introduces capital in the business, it is the equity to the business. It is not the asset to the business. You do not put the capital in the asset side. Where you put it, you put it in your equity and liability side, because you are bound to repay it back. Okay. Similarly, this is a dual entity concept, number one. Number two is, I mean, there are a lot of such concepts and conventions. I am just going to discuss about few, which are very important. Number two is the matching principle. So what does it mean, matching principle? That each year's revenue must be matched with that year's expense. Okay. So when we are purchasing a 1 lakh amount of machinery in year one and we are using it for revenue of year one, we are also using the machinery for revenue of year two, because this machinery is supposed to remain with us for 10 years. So we are using the particular machinery in year one, in year two, in year three, and 10 years we are using it. Okay. But the purchase has happened in year one. So now if you only put say 1 lakh total asset, if you consider it as your expense and you put it as in your income statement as expense, so your profit will be very less, right? It may be a loss. So your revenue maybe is 2 lakhs and your machinery itself is 1 lakh. So your profit will be, I mean, given there is no other expense, your profit is will come as 1 lakh, right? But it is not the case, and the next year all the revenues, there are no cost, no machinery use, as if you are considering that there is no use of machinery. So in all other, I mean the rest 9 years, you have not considered the use of the machinery for generating the revenue. But it is not the case. For generating each year's revenue, there is a contribution of this particular machinery. So what is done? We do the machinery's cost is apportioned over the 10 years period. It is distributed over a 10 years period. So each year, so if it is a straight line depreciation, we follow straight line method of apportionment of the depreciation. That means that 1 lakh, 10 years you are, I mean, equally you are going to divide it, distribute it among 10 years. That means each year it is coming 10,000, right? So 10,000 you will deduct from year one's assets. When you are considering the purchase of machinery, year one only you put in your asset side of the balance sheet 1 lakh. Okay. And in your depreciation at the end of year one, what you are considering in your income statement, 10,000. And in your balance sheet, what you are showing, depreciation is no more 1 lakh. You are showing 1 lakh minus 10,000. Now the value comes down to 90,000. Now year two, in the balance sheet, what is the amount? 90,000, right? 1 lakh minus 10,000. Again, you are taking 10,000 and you are putting in your income statement for year two's revenue generation. Okay. So now what is the balance remaining in the machinery account in your balance sheet? It is 90,000 minus 10,000, 80,000. Then in third year, again, you are taking 10,000 and you are putting in your third year's income statement as expense. So what is the remaining balance in third year's balance sheet? It is 80,000 minus 10,000, 70,000. This year, at the end of 10th year, you will find that the machinery value is coming 0. Okay. And each year you are considering 10,000 as your depreciation expense. From what principle we are doing that? It is following the matching principle, that we are using the machinery and we are generating the revenue. So machinery has been used and a part of it we should consider as our expense. Okay. So this is the matching principle. Similar way, when I discussed about the deferred revenue expenditure yesterday, since we are considering that this particular advertising expense is required for generation of revenue of that particular year, so a part of it we are considering as our expense. So each year we are deducting from that total advertising expenditure and we are taking it as our expense in our income statement. I think it is clear. Now next, intangible assets. So there is an recording of intangible asset also, which is very, very difficult. First of all, what are the intangible assets? Goodwills, trademarks, patents, copyrights, etc. Right? So when there is a value of patent, so here also what we do is we don't call it depreciation. We name it amortization. So if there is a patent value and for that you have spent your money, so you amortize Just like the depreciation, you take a part of it in your income statement. Similarly, for patent and these intellectual properties, you first recognize it in your balance sheet asset side, the whole amount, and each year you amortize a part of it, depending on what is the life of the patent, what is the life of that particular intangible asset. Okay. Now there is one intangible asset which is called goodwill. So goodwill, what comes under goodwill? Employees, proprietary knowledge, even brand, reputation, all these things. So in accounting, how goodwill is measured? Goodwill is only considered when company A is going to acquire company B. Then only the company A is acquiring the company B with its goodwill. So that purchase consideration is treated as the valuation of that goodwill. Otherwise, the company's own generated goodwill is not recorded in the company's financial statements. Now, two things I need to mention here. Number one is what is goodwill when you are going to just very pay attention and carefully you listen. When I am talking about own generated goodwill, what does it mean? That means that each company has some kind of over the years, with the depending on the credibility of the company among its different stakeholders, it develops some brand, right? So that brand has, when you as an investor, when you think about, say for example, Tatas, so you have a very good impression, right? So if when we talk about Ambani's or Reliance, we have a different impression maybe, right? So a particular kind of brand they develop, and depending on that, you also have a role to play in your investment decision making. So that particular impression has a role to play in your investment decision making. So that goodwill, that brand is very important. But how to value brand, right? So those are very, very subjective. So it is, there are different models of valuing the brands and all. But in our country, it is not till now it is not regulated or mandated that you need to record the brand valuations. But there are some kind of guidelines in other countries where you can, following that, you can record the brand valuations and all. So few companies, they voluntarily report or present their brand valuations. For example, the IT companies, the big IT companies, if you go to the your annual reports of your TCS or Infosys like of company, so you'll find that they generally provide the brand valuation, and it is not only because they are required to, they do it completely voluntarily. If you see where these companies are listed, you will find that not only in India, they are listed, they are cross-listed in many other countries' stock exchanges, okay? And on those stock exchanges, their different guidelines are being followed. So to follow those guidelines, to follow those compliances, they also require to um, record these valuations. Okay, so you will find brand valuations. They also present human resource valuation. For IT companies, the human resource, lots of value generated are generated from the human resource only, the employees, their knowledge, the value of the company depends on the human resource only. So they provide those human resource valuation, which is yet not mandated in India. Okay, so different models are followed. So these are this brand, this what the factors that the investors have the trust in the company. Those are inbuilt, right? The companies over the time they develop, but these are not recorded in company's balance sheet. So what goodwill is recorded? It is the goodwill, the amount when a particular company is going to take over another company, then only that goodwill is recorded. So exactly how we measure that goodwill, I'm not explaining here. But just remember that when the worth of that company, say for example, X amount is the worth of the company, and you are purchasing the company by giving Y amount. Okay, So this difference is actually what for you are giving the extra amount. This is because of the goodwill of the company. Okay, and that particular goodwill is recorded in the balance sheet of the company. So when you are going to acquire, that purchase consideration is considered as the goodwill of the company. Okay, so when you are purchasing another company, that particular company's goodwill is your asset now. Okay, so now why I have put the art of finance term here? Because as I told that, first of all, see here, it is under goodwill, it is written that art of finance. What does that mean? So now there are sometimes you may show that whatever you have purchased for and what is the worth of the asset, the difference is too high. So that means the goodwill amount is too high. If you find that in a company's balance sheet asset side, if there's a huge asset, so you are very happy, right? So the asset value is very high. But now see, now look into what are the items, and you will find that the most of the amount actually it is under goodwill. So goodwill, which is very subjective, right? So the hard assets you have, the building, the plant, maybe those have a very lesser amount and the goodwill has a very high amount. So what you are purchasing, that means what you are, where you are investing in some assets where it is mostly subjective, where you do not have any, you are going to sell it to someone, and someday you will find that the company is not performing well, it goodwill will go down and you have nothing to sell and nothing to realize, right? So that is called that is why I have mentioned here the term art of finance. So as I told that finance is not always 2 plus 2 equal to 4. So asset is very, an asset number is very good, not necessarily means that it is a very strong asset company. Okay, asset based company. So it may be that the mostly it is in the goodwill or the subjective items. Similarly, in the intangible assets, where it is mentioned as amortization, here also I have mentioned this art of finance. Why it is so? Because similarly, like your depreciation, this amortization also you are going to apportion it over a period of time. Now, what is going to be the life of that particular intangible asset? Again, you can put your discretion, right? So if you think that if it is, as I discussed yesterday also, if you think that the life is 5 years, then there is a lesser amount of amortization. If you think that the life is 3 years, there's a higher amount of amortization, and it is going to reflect in the expense of the expense side of the income statement, and ultimately it is going to affect your bottom line or the profit, right? Another thing is, just remember that two things we do not amortize or we do not depreciate. Number one is land. Land never depreciates because the value of the land always increases. It never depreciates. Another thing is goodwill. Goodwill we do not apportion or it does not, consider is over the time period. So it just remains the same way in your asset. So goodwill, whatever you put it in your year one, in the year two, in the year three, every year, it also never depreciates. It does not become any day. It never becomes zero. Okay, so it does not have a fixed life. Goodwill. So we do not depreciate it or amortize it. Similarly, land never becomes zero. So also, it remains the same value. It remains in our balance sheet. Next, the liability side. So asset side, we have already discussed fixed asset, more than 1 year life. Current asset, less than 1 year life. Life means it gets converted into cash. That is the life. Balance sheet liability side. What the company owes. So in assets, so far we discussed what the company owns, and here what the company owes. So how the company is funded. Yesterday also I told that it is very, very critical decision whether to go for debt, whether to go for equity, what are the consequences. Okay, debt, it is more risky, but you need not to dilute your ownership. But if it is equity, that means you are selling some of your shares to someone else. That means your stake is getting diluted and somebody is coming into the picture and they also now have the control over the company. So the more control the outsiders have in your company, the less say you do not have the control anymore. So the company will, I mean, whatever step you are going to take, you need to discuss with them, right? So the control, you will lose the control of the company. You cannot run it in your own way. So there are two, negatives, and the positives are also there. What is the positive of debt? That you need not to dilute your stake, and only the interest amount, which is a fixed amount, that you are going to pay to your debt providers. Okay, so if you are taking a 1 lakh amount of loan, and if it is a 5% interest, so 5,000 only you are going to pay as interest. Okay, but in case of equity, you need not to pay, and it is, I mean, the interest is fixed. So whatever may be the profit, whatever may be the earnings, I mean, maybe you are earning a huge huge earning you are making, so then also only it is a fixed amount of interest that you need to give. But in case of equity, there is no fixed payment. You need not to give your interest every time to the investors. Okay, but I mean, whatever is left after taking into consideration all your expenses and all your debt providers claim, whatever is left, that is going to be shared among the equity holders, right? So you as an owner and your investors. So these are the differences between debt and equity. Now, if the company does, I mean, is performing very well, so how the company gives back to the equity shareholders, it is called dividend, right? So the company pays interest to the debt providers and pay dividend to the equity holders. So how the company what is the difference between these two? So say for example, the company, if the company is performing very well, if the company performs well, yes, Sanyam has mentioned something, equity and share is same. Yes, equity and share is same. Okay, equity share, it is called equity share. Okay, so when the company performs well, think about it, it is also called this capital structure. The capital structure ratio or the debt equity ratio, it is also called leverage ratio. Why it is called leverage? Because you know the, I mean, how lever helps. Okay, so debt is a kind of lever. So when the company performs well, then having debt is not a very risky proposition. Why so? Because you are only giving on a regular basis a fixed amount of interest. Okay, but when the company does not perform well, then that fixed amount of interest, come what may, you have to give them, give the debt holders those fixed amount of interest. So even you are not in a position, you are making a loss, you have to bear all your expenses, your employees' salaries and all. Along with that, you have to bear the cost of interest also, right? So in that case, it is very risky. So as a company's management, I mean, you do not know that how your company is going to do. So it is good to have a balanced capital structure. But if you think that you are doing so well for over a long period of time, and you have a very, I mean, you can afford to have more debt, so it is always good, because even if your company does well, you need not to give more than the interest payment. You only you can restrict the expense to the amount of interest only, and the rest part you will enjoy whatever extra profit you are going to earn. Okay, so that time debt helps actually. You can get the loans, you can get the fund from the banks also, and you only need to make a fixed interest payment on a regular basis, and the extra profit what you are earning, you can only enjoy that. um, okay, so Shoham, you are asking that what is equity, right?
Yeah, ma'am, like,
Equity means stake. Equity means stake. So if you are holding an equity, that means you are holding a stake in the ownership of the company. So that is equity. Okay, the next is
Like ma'am, in the balance sheet,
yes.
like ma'am, in the balance sheet, as you said, we have shown asset and liabilities also. Then, how do we quantify the equity? What
Okay,
is the
equity. So whatever, I mean, equity means, say for example, your investor or you, I mean, there is there are 100 shares, total 100 shares in your company. I mean, what is the value of your company? What the capital you have raised? You are spreading it over 100 shares. Now your investor is holding 50 shares. Okay, so 50 shares have some value. Say for example, if it is I mean 5 lakhs, then 50 shares have 10,000 values each, and 10,000 values total. Okay, so these 50 shares, the total capital raised by the equity hold and held by the equity holders, that you will show in your balance sheet as equity capital. Okay, so if it is 5 lakh equity capital, so that is mentioned in the equity side of your balance sheet. So there is one asset side and one is liability side. Equity plus liability. In equity side, you will write that equity capital equal to, that is, say for example, if you have 50 shares and each have the 10,000, I mean 10,000 total number of shares, right? That 10,000 into 50, that becomes 5 lakhs. Okay, so 10,000 shares you are holding and each share has a value of 50 rupees. So sorry, I just told the other way down. Say for example, you are holding the 50 shares and you have the 10,000 value, then your total number of total amount of share capital is 5 lakhs. Okay, this way you show it in your balance sheet.
Okay, thank you.
Okay, the next is the liability, current liability. Okay, so similarly, just like the so also one thing I should mention here, it is also called the market cap. So when the company is a listed company, we also use the term market cap, and market cap represents the size of the company. Again, I want to say that what is the size of the company? Sometimes you will find that, I mean, many decisions depend on the size of the company. Or when we compare between two companies, we compare based on the size of the company. You cannot compare a company with I mean, huge number of employees and huge amount of assets and huge amount of market cap with just a company which has started just 1 year back, right? So why so? Because the size of the company is very small. You cannot expect that this new company is going to compete with a big old company in terms of revenue or in terms of profit. So the size of the company matters when we compare or analyze between two companies. So how we define the size of the company? So the basis of the, defining the size is, it may be the asset, what we compare, it may be their sales, what we compare, and it may be the market cap. So what is market cap? Market capitalization or market cap. So when the companies are listed, they have the market price. I just discussed about the capital market. Now what is market price? In capital market, the shares are traded. The shares value goes up and sometimes goes down depending on what is the perception of the market or the investors about the company. Okay, so market cap means, and each and every company has a market price. So you will find that the market price varies, and it goes up and down continuous basis. Okay, if there is a good news, the market price goes up. If there is a bad news, the market price goes down. I mean, if there is a good news about particular company or industry or economy or whatever, the price behaves accordingly. Okay, so if there is an increase in the oil price, there is a decrease in, suddenly you will find that the stock value of the automobiles company decreases. Okay, if there's an increase in, say for example, there is an increase in the this pandemic, the suddenly the there is an increased demand in the sanitizers and all these. The FMCG companies stocks goes up, something like this. I mean, these are very much connected, and it depends on the perception of the investors. Okay, so this is each and every listed company has a market price determined by the market only. These market price, along with the number of shares the company has issued capital, it is called the issued capital, number of shares issued. When you multiply the number of total shares into price of each share, that shows your total share capital, and it is your market cap. It is called the market capitalization. Okay, this is the market capitalization. In your balance sheet, another thing is balance sheet and income statement, the financial statements, what I am discussing now, it talks about the operations of the company. And another important concept, along with the separate entity concept, matching principle, whatever I discussed, another is the historical cost concept. So in balance sheet and income statement, you will find that it is the historical cost what the company records. It is not the market value. So when we present the those items or assets, liabilities, equities, whatever, we provide the historical cost. So machinery at the value what we have purchased 10 years back, we still provide that amount in the machinery account. In our machineries, I mean in our asset side, against machinery, we put the historical value of the machinery. In the equity side, we provide the book value of the equity. What do we mean by the book value? That means the price at which the shares are issued. It is not what is the current market price of that stock. The market value never comes in the balance sheet. The balance sheet only takes into account the historical cost. Okay. So this is another very important principle, that balance sheet follows the historical cost. And when we talk about purchasing a company, so there are different methods we follow for valuing a company. That is not in our syllabus, but time to time I will discuss different methods followed. For example, discounted cash flow method, relative valuation method, asset-based method, accounting-based method. There are different methods followed. So one of the very common method is the asset method, net asset method. What is that? That depending on the asset value, you are going to calculate what is the asset value of company B. If you are company A and you want to acquire company B, you calculate the asset of the net worth of that company B. What is the net asset value of company B, and that value you give to purchase the company. Now, when you are going to calculate the asset value while purchasing another company, then you consider the market value of those assets. Then you do not consider the book values, because book values are old, right? So whatever assets, then you need to recalculate that what is the current value of those assets that the companies have. Depending on that, you fix the price of the company. Okay. So these are few things you should know. Then coming to the liability side. So long-term liabilities are there. Equity I have discussed, I think. So now the current liability, similarly, just the same like your current asset. These are the short-term liabilities. So liabilities which you are obligated to pay it within a 1 year span of time. Say, for example, accounts payable, something you are, there are generally the terms are like you need to pay your suppliers within 60 days or 30 days or so. So this is the payables. You do not purchase the your materials in cash, right? So payables are there. Then wages payable, salaries payable, all these, which you are supposed to pay. For example, you are at the end of month, any month, and you are supposed to pay the salary. This is the 31st of 31st of August, and you are going to pay the salary for in September, after say 7th of September. Okay, this particular month. So what you are going to put it in your account, it is a payable, right? So far you are not paying it, it remains as your payable. Similarly, interest payable. The interest is meant for this period, but you are paying it later. So that means it comes as your payable. Income tax payable, deferred revenue, current portion of long-term debt. A long-term debt, it is not that the whole amount you are going to repay at once. So what is the current portion? What you are supposed to pay this year? So this is the current portion of long-term debt, which also comes under the payable, and the short-term loans. So short-term loans are basically the working capital loans. So these all comes under the current liabilities. Now, why we need the current liabilities? Because you just think about it. If you have something to pay, say for example, your employee's salary or the terms with your suppliers is you need to pay it within 30 days. But the terms with your customers is you will going to receive the payment from your customer, from your debtor after 60 days. So how will you manage these 30 days? You do not have cash say. And this liquidity crisis more happens for the small companies, small businesses or the startups, right? This continuously because they do not have much backup. So how to manage those? So then you take just short-term loan. So and you pay your the whatever payables you have, you meet those obligations, and then after 3 months time when you generate your receivables, when you collect your receivables in terms of cash, you can pay the repay back the short term loan also. So this way this working capital helps always, the short term loans that helps us to run the day to day operations. Especially it is important for the small business. Okay, and what is long-term liability? So equity we have discussed. Equity is also long-term because we do not. If I need to purchase material, I'm not going to raise equity, right? So for our day-to-day operations, we do not go for long-term bank loans or long-term equity fundraising. Okay, we raise our fund in a very low frequency. It is not that every month we raise fund. It is not possible. People are not going to also invest you for your day-to-day operations. They invest for the purpose of to see that your business is growing, for the purpose of growth, for the purpose of investment. They invest in you, not for your day-to-day salary, payment of salary and payment of interest. Okay, so long-term liabilities are taking long-term loans from from the banks and all, and for those things you need to sometimes mortgage. Okay, the maturity date, the rate of interest, any security placed to support the borrowing agreement should be clearly shown. So what you are placing to get those loans, that has to be clearly shown. Another thing is just since I have already discussed the asset, another thing just remember that asset not necessarily always means that you have some plant, machinery, land, building, and intangible assets. There are assets also called long-term investments. That means assets which is your asset investment in other companies' shares. So you are a company and you are investing money, you are putting money where you are purchasing shares of other companies. So that is also an investment. Why you do that? Say for example, right now you are not finding any opportunity that you can grow, but you have a huge amount of cash with you. So what you do? Just think about our personal life also. What we do when we have amount of cash, we can deposit the money in the bank, or we can buy some shares of some company, right? So we invest. Similarly, the company, when they do not find the opportunity to grow, they do not keep it just like in their cash account in their bank. They can invest those. So from that investment also they can get the return. That return is going to make their cash position healthy. But the return from those investment are not from the operations of the business. That is the return from the investments. Okay, So when you are going to analyze how the company's operations are, how efficient they are in their operations or how profitable they are, you should not consider those return on those companies' investment. That has nothing to do with the operating efficiency of those business. That return is totally out of the investment that is done by those companies. Okay. Okay, so it is already 12, I think. So should I continue, or we have you have other classes? Okay, I will. You do you have next week? You do not. You have Wednesday's class, right? Wednesday we have a class next week, right?
Yes.
I think Thursday there will be no class because of a holiday. So okay, we will complete it in the next class. Okay. Let me take the attendance. Okay, so you may leave now. Yeah.
So there class can be taken because I think Institute Foundation Day is on Wednesday.
Yeah, that was I was thinking that something I remember something is there.
And
Okay, so
Thursday, I
yeah,
think there is festival.
yeah, Thursday I know.
Thursday is
Thursday is their
Muharram.
holiday. Ha.
And
Yes, ma'am. Thursday is
Wednesday, I
Muharram.
think Institute has suspended all the classes due to the Foundation Day.
On Wednesday, no. So we will take the class on Friday because I mean, I just 2 months back I was affected by severely affected by COVID, and I cannot. I mean, take long classes even now. I feel very fatigued. Okay, so I cannot
Okay.
continue the class now, even if I wish to do so, but I'm not feeling that good. So
Okay,
we will continue it in the next week only. Okay.
okay, ma'am.
Okay.
And if you, whoever has any query, because many things I'm discussing, maybe it is not clear to all of you, you can, I mean, just mail me or you can message me also anytime. Okay. Yeah. And you may leave now. I've already taken the attendance.
Thank you, ma'am.
Thank
Bye,
you, ma'am.
ma'am. Take care.
Thank you, ma'am.
Thank you, ma'am.
Yeah.